Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial filings so you don't have to. And today we are diving into Grey Media Incorporated's latest report. Get ready because this isn't just about money. It is about how they're using it to reshape their future. And it looks like they're talking big bucks and making big moves. Before we get into the nitty-gritty, if you love getting crystal clear insights from these corporate documents, make sure you hit that subscribe button. And hey, we've got a fantastic community over on Discord where we chat more about these filings. Link is in the description below, so let's jump into what Grey Media has been up to. Grey Media Incorporated has just announced they've issued a significant amount of new debt. Basically, they borrowed a whole lot of money. This isn't just any borrowing though. It is $250 million worth of what they call senior secured. Second lien notes, think of these as loans that have a special promise attached to them, meaning Grey Media is putting certain assets on the line if they can't pay them back. These notes are due in 2032, so it is a long-term debt commitment. This is all happening under a supplement to an existing loan agreement, which they call an indenture. So what does this $250 million mean for Grey Media? They've issued these new notes to help pay off a portion of their older, more expensive debt. Specifically, they are using some of these funds to redeem their 10.50% senior secured first lien notes that were due in 2029. This is a smart financial maneuver. Imagine you have a credit card with a high interest rate, say 10.5% if you can get a new loan at a lower rate like 9.625% and use that new loan to pay off the old expensive one. You'll save money on interest payments over time. This essentially lowers their overall borrowing cost. The rest of the money is being used for general corporate purposes and to cover the costs associated with this whole deal. Now, these new notes called the additional notes are being combined with some similar notes issued earlier. They're all part of the same big loan of $900 million. This shows that they're essentially refinancing and adding to their debt structure. The terms are pretty much identical to the existing notes, meaning they all have the same interest rate, maturity date, and rules. The agreement that lays out the rules for these loans, the indenture, has some pretty standard rules. It puts limits on what Grey Media can do, like how much more debt they can take on, how they can spend their money on things like dividends or investments, and how they handle dealings with companies they're connected to. It also restricts them from selling off too many assets or merging without following certain procedures. These are all pretty common in big corporate loans to protect the lenders. Of course, there are also conditions that, if not met, can trigger a default. This includes not making payments on time, breaking other parts of the agreement, or facing serious financial trouble like bankruptcy. If a default happens, the lenders or a trustee representing them can demand immediate repayment of the entire loan, which can be a huge problem for a company. These notes mature on the 15th of July 2032. Interest payments happen twice a year in January and July, starting in January of next year, 2026. Grey Media does have the option to buy back some or all of these notes after July 2028, but there are specific prices and conditions for that. They can also use money from selling stock to pay back up to 40% of the note's value before that date, but only if most of the original notes are still outstanding. And if they sell off a big chunk of their business, or if there is a major change in who controls the company, they might have to offer to buy the notes back from holders. So, where do these new notes stand in the company's pecking order of debt? They are considered senior secured second lien obligations. This means that if things go south, these lenders get paid back before most other lenders, but not before those with a first lien on the same assets. They are on equal footing with other existing senior debt, but they rank higher than any future debt that is considered subordinate. However, they are effectively junior to any debt that is secured by assets that are not collateral for these notes, and they are junior to debt secured by a lien that ranks higher than the lien securing these notes. If it is all a bit confusing, just know that second lien means they're in a strong position to get paid back after the primary secured lenders, but before unsecured lenders. This important document, the first supplemental indenture, is officially filed with this report. It is essentially an addition to the original loan agreement that allows for these new notes to be issued. Grey Media also put out a press release on the 12th of December 2025 to let everyone know about this successful offering of the additional notes. And keeping with our tradition here at Corporate Decoder, let's look at the bigger picture. Grey Media is actively managing its debt by issuing new, seemingly cheaper debt to pay off older, more expensive debt. This is a sign of a company that is trying to strengthen its financial foundation and potentially increase its profitability by reducing interest expenses. The fact that they are able to secure this new funding, even with specific collateral backing, suggests that lenders still have confidence in Grey Media's ability to generate revenue and eventually repay its obligations. However, the significant amount of debt still means they are exposed to interest rate fluctuations and economic downturns. The strategy itself is sound, but the overall debt load is something to keep an eye on. The question really becomes whether this refinancing will free up enough cash flow to invest in growth initiatives, or if it is solely about managing existing liabilities. For now, it's a positive step in optimizing their capital structure. Alright, that is our breakdown of Grey Media Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this debt issuance is a smart move for long-term growth, or just a way to juggle their financial obligations? Drop your thoughts in the comments below. If this analysis was valuable to you, hitting that like button really helps us out. And don't forget to subscribe for more deep dives into the corporate world. And remember to check out our Discord community in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.